the measurement side just to see, okay, well, there's this big number that changed. Why did it change? And if it's the same derivatives they've owned and nothing's ever, then we can say, okay, I get it. Let's move on. And if it's not, then, but that's for us to kind of figure out. And if there's no disclosure around it, then we just don't know, right, what the reason is. So I would say that both of them are important.
James?
I think that material items should be reported when the company knows it's material. I think there are a number of issues with the disclosure and simplification the SEC provided, because within the SEC, there are numerous problems with the use of materiality. It's a total mess. There are multiple definitions of materiality, and in many cases it's used in the wrong way. But I want to point to a particular case that kind of highlights what the issues happen to be. A pharmaceutical company purchased a small pharmaceutical company, so it was not a significant transaction. But that small pharmaceutical company had substantial liabilities. The purchaser was well aware that they had a material problem, but it involved a non-significant transaction. They did not report over several quarters until it was basically totally obvious to the world that they had an issue. So when we talk about significant material, the problem I have in the language is not that you have significant in one place and material in another place, is that it's compounded. So that we're asking companies to look at significant transactions that have a material effect. So you could have non-significant transactions because the transaction itself was not significant, but there's at some point a material effect, and that still should be reported. And so it's not that, and I think that needs to be clarified. Investors want to know of material issues that the company is aware of.
You know, the way you described that, James, it sounds to me it almost goes to Russ's question as to whether, this is intended to capture events or transactions not captured under that, but measurement of, a liability. Betsy just did the touchdown.
Yeah, no, my comment was going to be along the same lines as James. In listening to everything, the most important thing that would be useful from my perspective as an investor is what is the definition of material that companies have, and when they're thinking about the events that are driving disclosure, are they thinking about it from that one specific event, or are they thinking about material as a specific event plus whatever other actions they would be taking to reduce the materiality of that event? So disclosure on that would be most helpful.
Rudy, you were up and down in this queue, and I'm not sure whether you still had a comment. Okay. Over to Jim.
So I think everyone on the board, and it sounds like everyone here, agrees that which is material ought to be provided. Like, that's the framework today. We have no intention to change that. In fact, you don't wait for the quarter to report material transactions. You have 8K requirements. I don't think we're trying to change any of that. I think this is in part responsive to at least at this point, questions about the whole objective of interim reporting. There was a debate about whether, in fact, we ought to move away from interim reporting to semi-annual reporting or 3 times a year reporting. And I think, Jonathan can do a lot better job of summarizing that input than perhaps I can. But I think the consensus, if this is fair, was no, we shouldn't move away from interim reporting. That was probably the majority of the perspective. But I think a lot of the respondents said we ought to challenge the depth of those reports. Are they too long? We ought to look at the volume. I think this is responsive to that. In part, we're hearing no, they ought to look identical to an annual reporting package. That isn't what we have today. We don't provide the same reporting deadlines. An annual report has got longer deadlines. We could think about if we want the package to look the same, perhaps we ought to the SEC ought to blow out the filing time. Annual reports are audited. Interim reports. So we live in a framework that's all based upon the costs and the benefits associated with that. I think there was tremendous pressure of saying, and we heard this last night, companies stay in the private markets longer because of the requirements, including interim reporting requirements. So I think those are all costs that we got to think about, is we can impose the cost and companies can stay private. What do an investor do then with less investment opportunity? Do you get the same then information in the private markets on an interim basis? So to me, this is a challenging question that can't be as simple as we just want them to look the same.
Russ?
So on that, this question is really for maybe Zach and then the preparers. To Jim Croker's point, it is probably highly unlikely the end result of this project would be interim disclosures looks just like the 10K. But I imagine, Zach, when you're looking at the interim financial statements, depending on what type of industry you're looking at, there are certain things that are in the annual report that you really want in the interim report, and there are certain things that maybe you don't care about. So if you were to look at Rudy's company, you probably would want to see on an interim basis credit quality disclosures. But you might not need to see, I don't know, your leases disclosure, because maybe that didn't change. And this is very difficult for a standard setter to write, because the way we have written standards in the past is if the transaction is material on a quantity amount, put the disclosures in. But is there an interim? Is there an interim to interim? Is there an in-between approach where you say the critical element to the company needs to be repeated, but the item that's not critical can be on this material significant? I just throw it out as an idea to bridge the gap, which I've sensed is going to be between investors and preparers here.
So just to be clear, I don't want to repeat at the 10K. But what I would like is if something is used every quarter and it's calculated already by the company, please disclose it if it's disclosed in the annual. If you are an apparel retailer and you've got a sales return reserve that's 3 or 4% of gross revenue, and you calculate that reserve every quarter, disclose it, because it's material every quarter, and we only see it once a year. We want to be able to see that data every quarter. You've already got it. Just disclose it. There are innumerable accounts that are exactly like that, where just seeing it every quarter really helps what we do and helps us proceed. An uncertain tax position, again, we're trend people. That's a one-time item. It's really important to that quarter, and you're probably going to disclose it, but how much does it affect my forward analysis? Probably not much at all.
David, back to you.
So, Andy, it might be good if we have the time to circle back to some of this discussion after we talk about AI. Because, Nick's talking about having, from a preparer standpoint, systems to, in place to push out the data. And we see Mark and Zach talking about how technology is being used to digest the data, maybe in different ways. And so I think some of the discussions, conclusions we have this afternoon really tie back to some of the cost-benefit discussions we're talking about and how to prepare interim information that is balancing costs and benefits for preparers and users.
I think that's a great point. I'm not suggesting we're going to have time today to circle back on that. But it does obviously fit squarely in the topic this afternoon about technology and the impact it has on preparation of financial statements and disclosures. Alice, you're next.
Yes, I would just, to kind of emphasize some of the points that have been made around the table already. From the preparer perspective, I would certainly agree with the point that Amy made around what is the intent and where would there be potential conflicts if there is some guidance, regardless of what the words say, if they were to conflict with the very explicit interim disclosure guidance in many of the standards. Another point, we do as preparers spend a lot of time around, is it material, is it significant? And so within our practice, what we tend to do is default to just disclosing it every quarter. It's easier to go ahead and disclose it than to have the debate and then have to answer the questions on the back end. Where was that disclosure? Why did you take it out? So as we look at our processes, with the exception of income taxes, the amount of effort that we spend on an interim disclosure versus an annual looks very much alike. And so there's a huge, where we have had the effort has come to the very explicit guidance in the individual standards. So I don't know if clarifying this language conceptually we agree, we support, but it's not going to really impact, I think, on a day-to-day the way we do prepare our financial statements if the guidance is still left in all the individual standards as it stands today.
I think we're back to Sue.
So the one thing that's troubled me about this is sort of the point that Amy raised, which is we have this very detailed list in 270 in the interims, and then we have, as you know, the trend, right, as we've set standards, particularly in the comprehensive standards that we've set up for the last 8 years, has been to include very detailed interim disclosures in the topics, and so it's bothered me that we have these two places, and I realize this is focused on summarized financial statements, but the point really hit home to me when Gordon talked about, and not to put you on the spot, Gordon, how not-for-profits that have public debt don't really look at this. They're looking at the topics. And so I found that interesting because, it would seem, from the surface, I realized the way it's worded here, publicly traded companies, but in my mind I had thought about it in terms of companies that issued summarized quarterly financial information. So I raised that point simply because from a navigation perspective, I think we've kind of, it's a challenge, I think, for companies when you have it in the topics and you have it here. Just some observations.
It does create interpretation questions. Lisa, you had your plate up, and okay.
With technologies, we view it as such a cost-saving methodology, but I think sometimes you have to overlook that cost savings that you're experiencing to actually dig down into the numbers and to find the anomalies. So I think trying to fit everything into a nice, neat spreadsheet that gets downloaded isn't necessarily doing our clients a service as we start to think about companies and what they're telling us.
Rudy.
Yeah, and just to add another preparer's voice to it, I have to admit, listening to Zach, I actually agree with him. When I think of, hold on, Alice, don't worry yet. When I think of the discussions that all of us are having with respect to the preparation of the quarterly, reporting, we're thinking about disclosing, what's in the earnings, quality of earnings, lumpy stuff in there, as well as, if you're looking at your growth trends, balance sheet, what have you, what's going on there, and making sure that because this is credibility, right? That you're being transparent with that so that, the analyst community understands what's going on. So that's really where we're having our discussions. I would say when I look at my 10Q, I have pages and pages on derivative disclosures. You got to ask yourself, is this really meaningful? And you've heard me complain about notionals and the offsetting and all that stuff. So that's what, it's not even on the list here, by the way, of things that should be reconsidered for, binning, because I like the red flag method, by the way, as you can tell by my comment. I'm not done yet. Pardon?
When you say it should be reconsidered, should it also be reconsidered for annual? So is your focus that it's not relevant for it? But it gets to the point.
Let's bite off the quarterly stuff now. There's just a massive amount of effort that goes into those fair value disclosures, and I work at a bank, by the way, and I would say the interest we get on those disclosures, they're less than nothing, so they're really small. And another example, of course, is the stuff you do on goodwill, and maybe you can say it's a period of time, but it's not significant at this point, and you put a lot of time. There's a lot of real estate around that. Another example is TDRs. They're not on your list here, but, I have disclosures around TDRs, and I really scratch my head thinking, why do I have that? Because the investing public is not really caring there. And as